Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, futures plunge on a shock tariff ultimatum, rocking global markets. With the VIX screaming a warning, will the opening bell trigger a market massacre or a historic opportunity for dip buyers? Second, alert. Trump's tariff gambit triggers market chaos as gold skyrockets past $4,700. Futures are in a bloodbath as a geopolitical ultimatum rocks Wall Street. The real story is a hidden crisis. Can the Fed fight both inflation and a slowdown? And will investors abandon the ultimate safe haven? Finally, OpenAI's $20 billion revenue surge masks a high-stakes gamble. Nvidia's $100 billion deal is on shaky ground. The AI giant's revenue has skyrocketed, but a shadow war over computing power is erupting. What happens to Nvidia and the entire tech sector if the cornerstone of the AI boom suddenly evaporates? Red alert. The rules of engagement just changed overnight. While the US markets were paused for the holiday, the geopolitical landscape shifted dramatically, and futures markets are screaming a warning signal that cannot be ignored. The calm close we saw on Friday masked a violent repricing of risk that is happening right now in the pre-market session. The S&P 500 officially closed at 6,837, down a modest 0.60%, but that number is already ancient history. The real story is the overnight action where S&P 500 futures plunged 1.5% and NASDAQ 100 futures dropped nearly 1.8%. Volatility is back with a vengeance. The VIX is spiking as traders scramble to reprice risk before the opening bell, reacting to a shock that few algorithms were programmed to anticipate. Why is the panic button being hit? The catalyst is President Trump's sudden ultimatum, a 10% tariff on 8 European nations, including Germany, France, and the UK effective February 1st, escalating to 25% by June unless the Greenland acquisition demands are met. This is not standard trade protectionism. Analysts point out this is the explicit weaponization of trade policy for territorial negotiation. From a policy perspective, this introduces a chaotic variable into the market's equation. Wall Street strategists are calling this an escalate to de-escalate tactic, a high-stakes negotiation leverage rather than a settled policy. However, the market hates uncertainty more than bad news. We are seeing an immediate capital flight from European equities, with the Euro Stoxx 50 down 1.3%. And that fear is bleeding directly into US futures. The valuation impact is immediate and sharp. Investors are repricing the risk premium for multinational corporations. If these tariffs hit, Capital Economics estimates a meaningful hit to Eurozone GDP, which inevitably impacts the earnings of S&P. 500 companies with significant European revenue exposure. Consequently, we are witnessing a classic flight to quality, but with a twist. Gold has shattered records, hitting $4,724 an ounce. This is critical to understand. Gold is not surging today because of inflation. CPI is holding steady at 2.7%. It is surging as a credibility hedge. Institutional investors are buying insurance against policy unpredictability and institutional instability. Amidst this macro turmoil, corporate fundamentals are fighting a war against the headlines. The financial sector is showing incredible resilience. Goldman Sachs and Morgan Stanley both crushed earnings expectations, with investment banking fees up significantly. This data confirms that despite the noise, deal-making is accelerating and corporate confidence in the M&A environment remains robust. This creates a stark divergence. The real economy of deal-making is heating up, while the headline economy of trade wars is cooling sentiment. Then there is the paradox in the technology sector. Taiwan Semiconductor Manufacturing Company, the absolute bellwether for AI infrastructure, posted record earnings and guided for nearly 30% growth in 2026. Under normal circumstances, this would send the NASDAQ soaring. Instead, tech is lagging. The market is discounting these stellar earnings because the tariff threat reminds investors how fragile global supply chains are. We are also observing a significant rotation under the surface. Capital is leaving the crowded trade of megacap tech and finding a home in small caps. The Russell 2000 is significantly outperforming large caps year to date. This is driven by a historic valuation gap. Small caps are trading at a 20% discount to large caps, and the premise that domestic-focused companies are better insulated from cross-border trade wars. The market rhythm has shifted from a liquidity-driven rally to a headline-driven chop. The next 48 hours are critical as the president heads to Davos. The market is looking for a walk back of the threats or a sign of negotiation. Meanwhile, we have the Federal Reserve meeting looming next week, with Vice Chair Bowman recently hinting at openness to rate cuts if the labour market softens further. The disconnect between strong bank earnings and geopolitical fear is the defining theme of the week. This isn't the end of the bull market, but it is certainly a stress test of the highest order. Keep your eyes on the VIX and the 6,800 level on the S&P 500. Heading into today's open, US markets are facing a sea of red. Futures are pointing to a brutal start, with Dow futures down 728 points and Nasdaq 100 futures sinking nearly 2% to a one-month low. A while back, we walked through how the first Greenland-related tariff ultimatum rattled Europe. The Stock 600 logged its biggest one-day drop in months. So today's slide is the US side of that same shockwave coming back around. The shockwave comes from an extraordinary geopolitical development. President Donald Trump has reignited tariff threats against 8 major European nations over the US' desire to purchase Greenland. The president announced that 10% import tariffs will hit countries like Germany, France, and the United Kingdom on February 1st and could escalate to 25% if a deal for the territory is not reached. We previously analysed this Greenland gambit as part of the scramble for Arctic critical minerals, think rare earth elements, and the same 8 nations we outlined before are in the crosshairs. Denmark, Norway, Sweden, France, Germany, the Netherlands, Finland, and the UK. Now, get this. These tariff threats create a potential nightmare scenario for the economy known as a stagflationary shock. The situation presents a fascinating duality. On one side, research from institutions like Yale University shows that a majority of tariff costs are typically passed on to US consumers, which would push up inflation. On the other, this deep uncertainty crushes business confidence, which slows down investment and hiring, hurting economic growth. This is the key problem. It puts the Federal Reserve in an impossible position. Do they raise interest rates to fight inflation or cut them to support a slowing economy? They can't do both. And that policy paralysis is what truly spooks investors. As we flagged a while back, the legal backdrop matters too. The use of emergency tariff powers has been under court review, so sudden changes in authority only compound the policy uncertainty markets are trying to price. And, there's another layer to this for US corporations. For years, they've been working to diversify their supply chains away from China. This is where the situation takes a more complex turn. With this sudden conflict with core European partners like Germany, companies are facing the need for a dual diversification. It means they may have to simultaneously de-risk from the world's 2 other largest economic blocs, which could significantly raise costs and reduce efficiency for US industry. At the open, look for potential weakness in sectors heavily reliant on European imports like autos and industrial machinery. We've seen how fast this can bite. When a 25% tariff hit autos and parts in a past episode, German car exports to the US slumped by nearly 14% within just a few quarters, an uncomfortable template if tensions escalate here. The reaction across global markets has been immediate. Investors are dumping stocks and running for cover, sending gold prices smashing through a record high. Gold surged past $4,700 an ounce for the very first time. Recall when this story first broke, Europe moved first. Today's rush into havens shows the stress is now fully global. However, if you zoom out, you'll see this isn't a typical flight to safety move. While gold is surging, the real test to watch at the open is the US government bond market. Specifically, look at the 10-year Treasury yield. Normally, in a panic, investors buy US bonds, which pushes their prices up and yields down. But this time, the US itself is the source of the instability. If we see Treasury yields failing to fall or even rising, it would be a powerful signal that investors are questioning the ultimate safety of US debt. This is a profound shift, as recent surveys of global central bank managers show they are already rethinking their reliance on US assets due to geopolitical risks. We've been warning that when Washington is the catalyst, the usual safe haven playbook can break today, offers a clean read on that. As a sign of the anxiety, Wall Street's fear gauge, the CBOE volatility index, has hit a 2-month peak. A spike in the VIX, which is that CBOE volatility index, above the key level of 20, may signal more than just a temporary scare. It could represent a shift to a new higher volatility regime driven by unpredictable policy. After all, if volatility stays persistently high, it increases hedging costs for businesses and investors, discourages corporate risk-taking, and ultimately can lead to lower stock valuations over the medium term. Continuing our last discussion about AI-led market leadership and concentration risk, also watch how the NASDAQ 100 QQQ trades relative to the S&P 500 resilience there has been the buffer, but in a policy shock, that spread can flip quickly. One investment director captured the gravity of the situation, warning this could lead to a serious rupture in the NATO alliance. That warning is so critical because this isn't just another trade dispute. Using broad tariffs for a territorial demand against multiple allies tests the very economic and political foundation of NATO. It could force investors to price in a new persistent alliance risk premium on European assets and the euro currency. In simple terms, it could become more expensive to invest in Europe because of this new political risk, which could trigger capital flight from the continent and fundamentally change the transatlantic partnership. We previously noted Europe's rapid military posture shift in Greenland at Denmark's request and the emergence of a broader geopolitical risk premium. Today's renewed threat entrenches that pricing rather than letting it fade. Amid the sell-off, there are a few outliers. In biotech, RAP Therapeutics is exploding higher, up more than 60% in pre-market trading after Britain's GSK announced a $2.2 billion deal to acquire the company. And precious metal miners like Hecla Mining are also seeing significant gains as gold soars. But the dominant theme is fear. The combination of a massive pre-market drop, record-breaking gold prices, and an unprecedented geopolitical standoff over Greenland creates a highly volatile setup for today's trading session. And as we said, when this first erupted, the Arctic resource angle is what makes this different. It isn't a one-off headline. It's a structural fault line the market now has to price day after day. Now, from geopolitical shockwaves rocking the entire market, let's zoom in on a high-stakes drama unfolding inside the world's most watched private company. Let's start with a single statistic that might just change your entire perspective on OpenAI. In a new blog post, the AI Lab's CFO revealed its annual revenue has exploded from $2 billion to over $20 billion. The company's finance chief, Sarah Fryer, called it never before seen growth at such scale, directly linking this monetization to a massive expansion of its computing power. And she framed 2026 as OpenAI's year of practical adoption, moving from capability demos to real deployments in health, science, and the enterprise. But that's not the whole picture. The real turning point is that this incredible revenue is happening alongside an even more explosive surge in spending on infrastructure. This is the AI credibility gap risk we've flagged before. The question is whether revenue growth can actually keep pace with these massive capital expenditures, or capital expenditure, we're seeing a massive investment cycle and the market is watching closely to see if the profits will follow. A critical piece of this expansion is a previously announced agreement with chipmaker Nvidia, ticker NVDA. Under the deal, Nvidia said it would commit a staggering $100 billion to support OpenAI as it builds out its data centers. A while back, we also analysed OpenAI's multi-year pact with Cerebras, a deliberate move to diversify away from single supplier risk. So the Nvidia tie-up sits alongside that strategy, not instead of it. To put that in perspective, the planned infrastructure would consume enough electricity to power roughly 8 million American homes for a year. Believe it or not, this single project highlights a massive trend shaping the entire economy. We are likely witnessing the start of a new economy-wide capital expenditure supercycle, where capital spending on AI infrastructure drives non-residential investment and productivity growth. The catch, and it's a big one, is the huge strain this creates on the energy grid. The International Energy Agency, or IEA, projects that global electricity demand from data centers will more than double by 2030. As we discussed a while back, that's the end of cheap compute theme colliding with power constraints, something that can feed pocket inflation and ripple through parts of the rate complex. This is the so-called power wall that the AI industry is running into, and it could become the primary bottleneck for scalability. Now, here's where it gets interesting. Nvidia recently told its own investors there was no assurance that its massive agreement with OpenAI would ever progress beyond an announcement to an official contract. Continuing our last discussion on diversification, That uncertainty is precisely why labs hedge across suppliers and architectures. So the thing is, the race for AI dominance is no longer just about software. It's about securing access to computing power or compute. This has become a geostrategic asset. We're seeing a competition between the US private sector-led model and China's state-driven AI strategy. For context, research from Stanford University shows that in 2023, the US saw $67.2 billion in private AI investment, which is nearly 9 times more than China's. We recently focused on how the stack is fragmenting GPUs, doing the heavy training, while alternative silicon aims at low-wire latency inference, and that matters as the focus shifts from demos to daily workflows. This intense competition is why securing massive amounts of compute, like the deal with Nvidia, is so critical for a company like OpenAI to maintain its lead. Any uncertainty here has ripple effects. This uncertainty hangs over OpenAI's plans as it gears up for a potential public debut, even beginning to test ads on ChatGPT. The company's entire business model, which it says will scale into finance, science, and medicine, relies on securing this unprecedented level of computing power, exactly the practical adoption Push Fry outlined. Ultimately, it all boils down to whether AI can truly deliver on its promise of productivity. This is what some are calling the enterprise deflation test. If companies can successfully integrate AI and it makes them more efficient, it could provide a powerful disinflationary force, especially for stubborn services inflation. However, the data so far is mixed. The US Census Bureau has actually tracked a recent slight decline in AI adoption among large companies, suggesting some are hitting a productivity paradox where initial implementation is difficult and doesn't immediately pay off. So the question for the market is whether OpenAI can prove its model scales profitably in the real world. Ahead of the bell, this high-stakes dependency sets the stage. Watch shares of Nvidia, ticker NVDA, for any reaction to this ongoing drama, as the future of the AI revolution hinges not just on code, but on securing power at a scale the world has never seen. So, heading into the open, keep an eye not just on Nvidia, but on the broader semiconductor sector through ETFs that track chip companies, and yes, keep AMD on your radar. Any perceived weakness in the OpenAI Nvidia relationship could create jitters. Also, watch the utility and energy sectors. If the market starts to price in a slowdown in data center construction, it could temper expectations for future electricity demand. And if the power wall narrative heats up again, keep an eye on longer dated yields. The underlying tension is this. The AI boom has fueled massive valuations, but that boom depends on a physical infrastructure build-out that is facing real-world bottlenecks in contracts, power, and capital. Today's session will be a test of the market's conviction in that story.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.